Welcome along. Today we're digging into something really key. For UK landlords letting out residential property, it's all about tax relief on mortgage interest.
Mhm.
Getting this right can make a big difference to your bottom line, and we're able to explore this today thanks to my tax accountant, the well-known UK firm. They've helped arrange this discussion for us.
Yes, it's definitely a topic well, it's seen some major changes over the last few years. So staying up to date is absolutely vital for landlords. You don't want to miss out, or worse, make mistakes on your tax return.
Okay, so the whole way this works has shifted, hasn't it? It's not quite as straightforward as it maybe once was. What's the kind of headline change?
Absolutely. So before April 2020, landlords could basically deduct their mortgage interest costs directly from their rental income before calculating tax.
Right, reducing the taxable profit.
Exactly. But now it's been replaced by a 20% tax credit system.
A credit. So instead of lowering the profit figure you're taxed on, this actually just reduces the final tax bill itself.
Precisely. And crucially, this 20% credit isn't automatically applied to all your mortgage interest. It's based on whichever amount is the lowest out of three things.
Okay, what are those three?
Your total finance costs for the year, so the mortgage interest and related fees. Second, the profit your property business actually made in that tax year. And third, your adjusted total income for the year. That's basically your total taxable income above your personal allowance.
Ah, okay, so the relief is capped by one of those three.
Exactly. It's the lowest figure that dictates the maximum credit you can get.
Interesting. Could you maybe walk us through a quick example? Say a landlord has £10,000 in mortgage interest costs.
Sure. Let's say they have £10,000 in finance costs. Now, if their property business profit is, say, £12,000 and their total adjusted income is £40,000, well, the lowest of those three is the finance cost itself, £10,000.
Right.
So they get a tax credit of 20% of that £10,000, which is £2,000.
And that £2,000 comes directly off their income tax liability.
That's correct. It directly reduces the amount of tax they have to pay for that year. But if, say, their property profit was only £8,000 that year, even with £10,000 interest,
Then the credit would be based on the £8,000 profit instead, so £1,600.
you've got it. The profit figure would be the limiting factor in that case.
Right, that really highlights the link to profitability. So, why did they bring in this change? What was the aim?
Well, the main driver was really about fairness. The old deduction system tended to give a bigger benefit to landlords with large mortgages, particularly those paying higher rates of tax, 40% or 45%.
Because the deduction was worth more to them.
Exactly. They save. Yeah, good idea. So you've got your personal allowance. That's up to £12,570 where you pay 0% tax.
Mm-hmm.
Then the basic rate band is £12,571 up to £50,270, taxed at 20%.
Okay.
After that, the higher rate kicks in at 40% for income between £50,271 and £125,140.
Right.
And anything over £125,140 is taxed at the additional rate, which is 45%.
And crucially, your rental income gets added on top of any other income you have, like salary or pensions, to work out your overall tax band, doesn't it?
Absolutely. So even a relatively modest rental profit could potentially push someone into a higher tax bracket overall.
Okay, makes sense. So who actually qualifies for this 20% tax credit? And are there landlords who don't use this system?
Generally, it applies to individual landlords who rent out residential property. That includes UK residents and non-residents.
Okay.
It also applies to partnerships where the partners are individuals, and some trusts, again, if they're involved in residential lettings.
And what sort of finance costs are covered? Is it just mortgage interest?
It's mainly mortgage interest, yeah,
Yeah.
but also interest on things like overdrafts if they're used purely for the property business. And fees directly related to taking out or repaying mortgages or loans count too.
Right. So who falls outside of this? Who are the exceptions?
The big one is limited companies. Landlords operating through a company structure aren't affected by this Section 24 change.
So they still deduct interest fully.
Yes, they can deduct finance costs as a normal business expense against their profits before calculating corporation tax.
Okay. Any others?
Well, furnished holiday lettings, or FHLs, have also been exempt up to now. They could still deduct interest. But that's changing from April 2025. They'll be brought into this 20% credit system too.
Ah, okay. Good to know that change is coming.
And finally, this whole system only applies to residential property lets. Commercial properties are unaffected. Landlords can still fully deduct finance costs for those.
Right. So the property type is key.
Okay.
So for an eligible landlord, what's the actual process for claiming this relief? What do they need to do?
First things first, good records are essential. You absolutely need your mortgage statements showing the interest paid during the tax year.
Hmm.
You also need clear records of all your rental income and, of course, receipts for all other allowable expenses, repairs, insurance, letting agent fees, that kind of thing.
And then when it comes to the tax return itself, the self-assessment.
Yes, you'll be using the SA-105 form, which is the UK property income section. The crucial box here is box 44.
Box 44, what goes in there?
That's where you put your total residential finance costs for the year, the mortgage interest, and those other related finance costs we mentioned.
And not anywhere else.
Definitely not. A really common mistake is people putting mortgage interest in box 24 along with other general expenses like repairs. That's wrong. Box 44 is specifically for these residential finance costs that qualify for the 20% credit calculation.
Okay, box 44, got it. Are there other pitfalls people should watch out for?
Yes, a couple more. Another thing is forgetting about finance costs carried forward from previous years.
If profits were too low in the past to use all the relief.
Exactly. If you couldn't get the full credit in a previous year because your profits or income were the limiting factor, the unused finance costs can be carried forward. You need to enter those brought forward costs in box 45.
Box 45 for carried forward costs. Okay.
And one other thing, if you have a single loan that covers, say, both a residential flat and a shop downstairs.
A mixed-use loan.
Yes. You need to split the interest fairly between the residential and commercial parts. Only the residential portion goes in box 44 for the credit calculation. The commercial part can still be deducted as an expense elsewhere.
Right. Proper apportionment is needed there. And deadlines.
Standard self-assessment deadlines apply. Online filing is due by 31st January following the end of the tax year. If you're filing a paper return, it's much earlier, 31st October. Missing them means penalties.
Definitely want to avoid those. Okay, thinking about being tax efficient, are there ways landlords can legitimately maximize the relief they get from this 20% credit?
Well, one aspect is timing. Since the relief is capped by profits, strategically timing when you carry out, say, allowable repairs could potentially boost your profit in a year where you have high finance costs, ensuring you can use the full credit.
So aligning expenses and income where possible.
It's something to consider, yes. More fundamentally, though, make sure you're claiming absolutely every allowable expense you're entitled to, not just finance costs. Think repairs, maintenance, insurance, agent fees, accountancy fees.
Distinguishing repairs from improvements which aren't usually deductible against income.
Exactly. Claiming all legitimate revenue expenses helps maximize your profit figure, which in turn can help maximize the finance cost credit you receive up to the level of your actual finance costs, of course. And definitely use any carried forward finance costs from box 45 in years where your profits are higher.
Right. Use them when they won't be restricted. Now, we mentioned the 20% credit relates to the basic tax rate. How does this specifically impact higher rate taxpayers, people paying 40% or 45%?
That's a key point. For them, this system generally means less relief than before. Under the old rules, they got relief at their marginal rate, 40% or 45%. Now, everyone gets relief, effectively capped at the 20% basic rate level via the credit.
So their net tax bill on rental profits is likely higher now.
Yes, for many higher and additional rate taxpayers, the restriction of finance cost relief to the 20% credit has resulted in a larger overall income tax liability compared to the old system.
Are there ways higher rate taxpayers might look to mitigate this? Any strategies?
There are a few things people consider, but they all need careful thought and usually professional advice.
Yeah.
One possibility is changing the ownership structure, perhaps transferring a share of the property to a spouse or civil partner who is a basic rate taxpayer.
Okay.
Increasing personal pension contributions is another way to potentially reduce overall taxable income, which might help.
Right. Pension contributions get tax relief too.
They do. And then there's the option some explore of transferring their properties into a limited company structure. As we said, companies aren't subject to the Section 24 restriction.
But that sounds like a big step. Are there catches?
Oh, absolutely. Transferring properties into a company can trigger capital gains tax on any uplift in value and also potentially stamp duty land tax payable by the company on acquisition. It's complex and definitely not a one-size-fits-all solution. Needs proper modeling.
Definitely one for expert advice then. What about landlords living overseas but renting out UK property? Any specifics for non-residents?
Yes, they need to be aware of the non-resident landlord scheme, the NRLS.
Okay, what's that involve?
Typically, the letting agent, or sometimes the tenant, has to deduct basic rate tax from the rent before passing it on to the non-resident landlord.
Tax withheld at source.
Yes, but the landlord can apply to HMRC for approval to receive the rent gross without that deduction.
Hmm.
Either way, though, non-resident landlords must file a UK self-assessment tax return to declare their rental income.
And they claim the 20% mortgage interest credit on that return.
Correct. They calculate their profit, report the finance cost in box 44, and HMRC works out the credit. They should also check if there's a double taxation agreement between the UK and their country of residence, which might affect how their income is taxed overall.
Okay. And for landlords juggling multiple properties, maybe a mix of residential and commercial under one mortgage. We touched on apportionment.
Yes, careful apportionment of the finance costs is vital in that situation. Only the interest relating to the residential goes towards the 20% credit calculation. The commercial part is treated differently.
Got it. Anything else for multi-property landlords?
Well, looking ahead, making tax digital for income tax self-assessment MTD for ITSA is coming. Landlords with property income over £30,000 will need to comply from April 2026.
Which means digital records and quarterly updates.
Essentially, yes. It's a significant shift in reporting requirements, so landlords, especially those with larger portfolios, need to start preparing for that now.
Okay, good heads up. So let's try and boil this down. What are the absolute must-remember takeaways for landlords dealing with mortgage interest tax relief?
Okay, key points. 1. Relief is now a 20% tax credit. It reduces your final tax bill. It's not a deduction from income.
Right.
2. Use box 44 on the SA 105 form for your residential finance costs. Critically important.
That's 44. Got it.
3. Remember, the credit is capped. It's based on the lowest of your finance costs, your property business profit, or your adjusted total income.
Below SIF is 3.
4. Don't forget about carrying forward unused finance costs using box 45. And finally, file your self-assessment return on time to claim the relief.
Excellent summary. This has been incredibly helpful in clarifying what can be, let's face it, quite a tricky area of tax.
It certainly has its complexities.
And if listeners feel they need more specific guidance tailored to their own situation, especially since my tax accountant arranged for this discussion, where should they turn?
Well, for that kind of personalized expert advice on navigating these rules, ensuring you're compliant and claiming everything correctly, reaching out to the specialists at my tax accountant would be a very sensible step. They deal with this day in, day out.
Great advice. Thanks very much for walking us through all that.
My pleasure.